Good day, everyone, and welcome to another episode of For Our Financials Financial Forum. Today on our show, we're talking the rally rolls through turbulence, AI earnings drive markets. And in our Wealth Wisdom workshop today, we will talk about safeguarding retirement income. Welcome back, everyone. This is Markets in Motion, where we break down the week's biggest market movers and set the stage for what investors need to know right now. And Jeffrey, what a week it was. Stocks pushed higher as investors essentially looked past the stalled Middle East peace talks and instead look back in on corporate earnings. The numbers tell the story here. The S&P 500 climbed almost a percentage point, 0.91%. The NASDAQ added 1.12%. The Dow rose 0.55%, and overseas gained almost 0.6% as well. So everything was up a little bit. But the bigger headline, April just became the biggest month in 5 years for both the S&P and the NASDAQ. So that's kind of a powerful statement about the market's resilience, especially given all the geopolitical backdrop that we're seeing. So early in the week, markets were clear and uneasy. Prices were rising. The peace talks were stalling, and sentiment was shaky. But by midweek, the tone flipped. The Fed held rates steady, no surprise there, but the dissent inside the meeting caught everyone's attention. And then earnings rolled in Wednesday afternoon, and investors liked what they heard. That's when the rally really took shape.
Exactly, Marcus. And then Friday kind of capped it off with another push higher as oil prices eased, and yet another mega cap tech delivered a blockbuster quarter. And that helped the S&P notch a fresh all-time intraday high, which was remarkable considering the geopolitical noise we're navigating right now. And then speaking of the Fed, the vote was 8-4, the most divided vote since 1992. Markets don't love uncertainty, and dissent inside the Fed usually signals that policy direction is becoming less predictable. So we also got a bit of leadership news. Chair Powell confirmed he'll remain on the board as a governor after his term ends May 15th. And the Senate Banking Committee advanced Kevin Warsh toward confirmation as the next Fed chair. That transition alone could shape the next several years of monetary policy. So yes, markets did climb, but they climbed through a minefield of geopolitical tension, Fed uncertainty, and energy-driven inflation pressure. That's a story behind the story, I guess you could say.
Yeah, and that minefield is only getting more complicated. The U.S. naval blockade of Iran is now fully implemented, cutting off roughly 90% of Iran's seaborne trade. So that's hundreds of millions in daily economic damage, and it's reshaping both regional politics and global energy markets. So oil pushing above $100 has been the clearest market signal so far, and it's one reason early week trading was so choppy. But the bigger picture is that markets are powering through higher despite all of this. So April surge, more than 10% for the S&P, is the strongest since 2020. Alphabet alone added $421 billion in market cap after its earnings beat. That's the kind of tech-driven momentum that can empower macro headwinds, at least in the short run. But the divergence between Wall Street and Main Street is widening. Private sector financial assets are on track to grow nearly 7 times faster than our gross domestic product. So that's a gap worth watching.
And then that brings us to the week ahead, and we've got a packed economic calendar. So Tuesday, we got new home sales plus the Fed speeches. Wednesday, we got ADP employment. Thursday, we got jobless claims, productivity, construction spending, consumer credit. And then Friday, we got the big one, the U.S. employment report plus the consumer sentiment. And then earning season continues, of course, with some heavy hitters. And Tuesday, we got AMD and Pfizer. Wednesday, we got Disney, Uber, CVS. And then Thursday, we got McDonald's, Gilead, and McKesson. So the market has momentum, but it also has a full plate.
Absolutely. So that'll wrap up Markets in Motion for this week, and we'll be back after the break with Finance in Focus. Okay, so let's dig deeper into that geopolitical layer because it's influencing everything from energy prices to investor psychology. The blockade of Iran is not just a military maneuver, it's an economic chokehold. Reports indicate Iran is accelerating missile and munitions production during the ceasefire, preparing for a potential escalation. Inside Iran, moderates want negotiations. Hardliners want retaliation, and the political divide between them is widening. Meanwhile, in Washington, the administration is framing the situation as terminated for war powers purposes, but Congress isn't buying it. Even within the president's own party, skepticism is rising. That political tension matters because it shapes the probability of further military action, and markets are watching that probability closely.
And then energy markets are the transmission mechanism. So oil above $100 is not just a headline, it's a tax on consumers. It's a margin squeeze for businesses and a potential accelerant for inflation. That's why the Fed's divided vote is so important. A split Fed suggests the path forward is less certain, and the markets hate uncertainty more than they hate bad news. We're also seeing movement on the infrastructure side. The administration approved the Bridger Pipeline expansion and the Keystone Style project aimed at boosting North American energy flows. At the same time, Exxon and ConocoPhillips are quietly sending technical teams back into Venezuela as U.S. and European firms explore reentry into that market. And that's a long-term supply story that could eventually ease pressure, but not in the near term.
Correct, absolutely. So let's shift over to corporate earnings for a second, because this is where the market's optimism is coming from. Tech continues to carry the torch. Apple guided revenue above expectations, with China revenue up 28%, even though iPhone sales were constrained. Meta stumbled post earnings as investors questioned their heavy capex and slower growth expectations. Amgen actually posted a solid 4% rise in Q1 product sales. Twilio beat expectations and raised its full-year outlook, and Reddit projected Q2 revenue above estimates, leaning heavily on AI-enhanced advertising tools. So the through line is clear here. AI continues to be the dominant force, shaping revenue, margins, and investor sentiment.
And while markets are celebrating, the macro backdrop is flashing some caution lights. Fitch issued a warning that the U.S. fiscal position is deteriorating, with debt levels far above peers with similar credit ratings. That's not an immediate crisis, but it's a structural risk that eventually will matter. And then on the trade front, tensions with China remain elevated. U.S. officials have raised concerns about China's new extraterritorial supply chain rules, while Beijing, continues to criticize U.S. trade restrictions. Taiwan remains the biggest flashpoint, and markets know it. So in a more symbolic move, the administration is removing certain whiskey tariffs following King Charles III's visit. It's a small gesture, but it signals an attempt to ease pressure in at least one corner of the trade landscape, which is good.
Yep. So here's the bottom line. The markets are rallying hard, but they're rallying through a geopolitical tension, Fed uncertainty, and structural economic risk. Earnings are doing the heavy lifting, especially in tech, and investors are rewarding companies that show clear AI-driven growth.
And then, and the week ahead is packed with data and could either reinforce this rally or introduce some friction. So we'll be watching employment numbers, Fed commentary. I'm in earnings with several bellwether companies. So still some stuff ahead.
Absolutely, absolutely. So that will wrap up Finance in Focus. And after the break, we'll be back with the Wealth Wisdom Workshop.
Social Security is one of the most important income sources for retirees. But with long-term funding challenges and shifting rules, uncertainty is growing, and that creates real anxiety for people who depend on it. The good news is that you don't have to navigate that uncertainty alone. At Friar Financial, our dynamic retirement income strategy helps you build a plan that protects your income even as Social Security evolves. Because confidence in retirement shouldn't depend on Washington.
Welcome to the Wealth Wisdom Workshop. Our topic for today is how to recession-proof your retirement income plan. So you spent years saving, investing, and preparing for a comfortable retirement, but when headlines warn of a potential recession just as you approach your retirement date, it's pretty natural to feel uneasy. And while no one can predict exactly what the next downturn will arrive, economic cycles are inevitable. So the good news is you can't control a recession, but you can control your readiness for one. This workshop outlines the core strategies that help safeguard your retirement before, during it, and after a downturn. So let's first strengthen your safety net and build a robust cash reserve. So let's get that cash up. A recession often brings job losses, reduced hours, or unexpected expenses. Without a cash buffer, you may be forced to tap retirement accounts early, derailing long-term goals and triggering taxes or penalties. And so the key principles within that are, depending upon your industry, aim for 3 to 9 months of essential expenses expenses in an emergency fund. We want to use a high yield savings account to keep your cash accessible while also earning interest, preferably above the rate of inflation to preserve your purchasing power through inflation. And then we're going to treat this fund as a shield that protects your retirement accounts from premature withdrawals. Then our next focus is to reduce vulnerability. And do that, we want to pay down high interest debt. As we discussed last week, we retire debt before you do. Debt becomes our heavier during a recession. Income may shrink where payments don't. Why this matter? It's eliminating debt free from cash up essentials like housing, food, and healthcare. Lower debt reduces financial stress and protects your credit score. A strong credit profile gives you flexibility when the economy recovers. And then our biggest thing is we want to stay the course too. So we want to keep our investments in the market. Market downturns are uncomfortable, but they're also temporary. Long-term investors who stay invested recover fast and grow more wealth than those who pull out during volatility. You want to avoid moving retirement savings into safe accounts out of fear. Maintain a diversified mix of stocks and cash in line with your risk tolerance. Rebalance often as needed, or use your automatic rebalancing employer plans to keep your portfolio aligned with your goals. Selling during a downturn locks in losses. Staying invested positions you for the rebound. Then we kind of get in lastly, recession is the worst time to make impulsive decisions and the best time to have an expert in your corner. A personalized plan is what matters the most. There's no one-size-fits-all recession strategy. Your age, income sources, savings level, and retirement timeline all shape the right approach. What remains true for everyone is that a little discipline today creates a lot of stability for tomorrow. It's never too late to prepare. A thoughtful plan can turn uncertainty into confidence at the end of the day. So working with a professional helps you build savings, eliminate debt, and optimize your investments so your retirement income plan can weather any economic storm. And that's what wraps up today's show. So hopefully you guys got some great advice or some great information. And we'll see everybody next week.
Thank you.